Have you ever wondered what it would be like to live off passive income without worrying about working every month to pay the bills? It seems like a distant dream, right? Well, what if I told you that this dream might be much closer than you think? Warren Buffett, one of the greatest investors of all time, built his fortune with a simple strategy: living off dividends. And you don't need to be a billionaire to do the same. In fact, there is a way to generate up to $4,400 per month solely from dividends, and this can happen faster than you think. Wizard, the secret lies in understanding how the power of dividends, combined with some smart strategies, can transform the way you think about money and investments. Most people still believe that you can only live off passive income in retirement or after decades of hard work. But Buffett shows us another reality, a reality that many are unaware of. And the best part? You don't need a huge capital to get started. With the right financial planning and the right stocks, you can start seeing your money work for you instead of the other way around. And stay tuned until the end, because we are going to reveal the secret about how much you actually need to generate $4,400 per month in dividends. You will be surprised by the number. But first, we will teach you the steps to get there. And the first step is seizing opportunities. This video is for informational and educational purposes only and does not constitute investment advice. Consult a qualified financial advisor before making any investment decisions. Investing involves risks, including the loss of capital. Past performance does not guarantee future results. Warren Buffett, one of the greatest investors of all time, always emphasizes the importance of knowing how to seize opportunities. It is interesting to note that in the world of investments, they are not always available all the time. When we talk about building wealth, this becomes even more evident. Imagine you have your eye on a stock that regularly pays dividends but hesitate to buy. The moment you delay this decision, you might be missing a chance to secure a source of passive income. For those seeking financial freedom, knowing how to act at the right moment is a crucial skill. A good practical example of this is Buffett himself, who talks about the circle of competence, that is, investing in what you know well. He doesn't wait for the perfect moment, but rather for the opportune moment within what he deeply understands. An investor who recognizes an opportunity and acts based on concrete data and not emotion increases the chances of financial success. In practice, this can mean investing in a stock of a company that regularly pays dividends, such as Procter & Gamble or Microsoft. These are companies that historically not only distribute consistent dividends, but also demonstrate stable growth over the years. Opportunities in investments are like waves. Some come big, others smaller, but they are always there. It is up to the investor to be prepared to ride the right wave. And this often means not waiting for a quick return, but for wealth building that accumulates over time. As Buffett would say, the market is a device for transferring money from the impatient to the patient. Knowing how to identify these waves and being prepared to act can be the difference between a peaceful retirement with good passive income and years of financial uncertainty. This posture of acting at the right time is also reflected in other aspects of life. Financial planning is a key piece here. Having a well-structured plan allows you to take advantage of opportunities without compromising your capital, and thus build wealth in a safe and scalable way. If you already have in mind that investing in dividend-paying stocks is a path to achieving financial freedom, then it's time to prepare your strategy for the next step: understanding the real power of dividends. Power of dividends. Dividends are one of the best ways to generate wealth over time. An impressive fact: in 2020, companies in the S&P 500 index paid over $58 billion per month in dividends. This shows how these profit distributions represent a true engine for creating passive income for those seeking a peaceful retirement or even achieving financial freedom. The most interesting part is that by reinvesting these dividends, you can accelerate the growth process of your wealth without needing significant additional efforts. This power of dividends goes beyond the numbers. Think of the following. Companies that regularly pay dividends are, in a way, showing their financial solidity. A classic example is giants like ExxonMobil or PepsiCo, which have a history of consistent payments. These dividends can be the foundation of continuous passive income, which over time turns into a significant source of money, especially if you start early and maintain a disciplined reinvestment strategy. To understand the real impact of dividends, Imagine that you have invested in a company that pays an annual dividend yield of 4%. If you reinvest that money, over the years, the growth becomes exponential thanks to the power of compound interest. Many investors, like Warren Buffett, have followed this strategy of reinvesting dividends over decades, creating a true wealth-generating machine. It's no wonder Buffett is known for valuing companies that offer this type of return so highly. And the interesting thing is that this process can start in an accessible way. If you are interested in building a portfolio focused on dividends, you can look at companies like Verizon or Realty Income, which offer stable and predictable dividends. But you might be wondering, what are dividends? And why invest in companies that consistently distribute them? Let's go, Wizards! Let's answer all these questions. What are dividends? Dividends are a portion of a company's profits that are distributed to its shareholders as a way to reward them for investing in the company. Basically, by buying shares of a company that pays dividends, you are purchasing the right to receive a slice of its profits. This is one of the most efficient ways to create a passive income stream. For those who wish to achieve financial freedom, relying on predictable income from dividends can be a real game changer, especially over time. It is interesting to note that dividends can be paid in different ways. Some companies choose to make quarterly payments, while others may distribute their profits annually or even monthly. Companies like AT&T, which pays quarterly dividends, and the infrastructure company Main Street Capital, which offers monthly dividends, are good examples of this. These payments might not seem like much at the beginning, but when reinvested, they create a compound effect that can significantly increase your wealth over the years. Another advantage of dividends is that, unlike other types of income, such as a salary, they can continue to flow even when you are not working directly. Once you invest in dividend-paying stocks, you receive profits without needing to perform any additional work. This is especially useful when we think about retirement. After all, who wouldn't like to have a steady source of income without needing to sell your shares or reduce your wealth? Additionally, dividends can be a way to protect your money against inflation, as companies generally adjust their payments over time. Now that you know what dividends are and how they work, it's time to build a strong portfolio filled with stocks that pay good dividends, thereby creating a true passive income-generating machine. This brings us to a crucial question: how to select these stocks and assemble a portfolio. Building a strong portfolio. Building a strong portfolio is one of the keys to ensuring passive income and achieving financial freedom. Warren Buffett is a strong advocate of selecting dividend-paying company stocks, but he also emphasizes the importance of diversification. Having a portfolio composed of different sectors of the economy can protect the investor from market fluctuations. For example, by investing in technology companies like Apple alongside consumer staples companies like Procter & Gamble, you create a balance that increases the safety of your investments. Constructing a dividend-focused portfolio is not just about diversification across sectors, but also about choosing stocks that have a history of paying dividends. Companies like Johnson & Johnson and Chevron are known for maintaining a stable policy of distributing profits to shareholders, regardless of economic fluctuations. This provides the investor with a sense of security, knowing that the income is guaranteed even during periods of higher market volatility. To start building this portfolio, it is necessary to conduct a careful analysis of the companies. Look at the history of dividend payments. Observe the growth of dividends over the years, and also the sustainability of these payments in relation to the company's profits. A good practical example would be looking at Johnson & Johnson, which has been increasing its dividends for consecutive decades, ensuring growing income for shareholders. Diversifying your income sources within the portfolio is like planting different trees in an orchard. Some may bear fruit sooner, others take longer, but in the end, you harvest from all of them, ensuring a steady yield. It is important to remember that patience is your ally in this process. Building a strong portfolio takes time, but it is precisely this long-term mindset that can ensure success. In the end, the goal is to have a portfolio that continues to generate money even if you decide to stop working one day. And speaking of the long term, there is something even more important when we think about investments: time and the power of reinvesting these dividends, which can turn small returns into great achievements. Long-term perspective. Having a long-term perspective in investments is what differentiates those who achieve financial freedom from those who fall by the wayside. Warren Buffett always emphasizes that the market can be volatile in the short term, but over time, it tends to reward the patient. When you invest in dividend-paying stocks, the secret is to give time for these payments to accumulate and generate even more money. Those who start investing today with a long-term mindset are taking a big step toward a comfortable retirement. Buffett does not worry about the market's daily fluctuations because he knows that real growth comes with time. He often compares the market to a game of patience. In the short term, it may seem chaotic, like a betting race where everyone wants to be first. But in the long term, it is like a fair scale that rewards those who knew how to wait and trust their choices. An example of this is the power of companies like McDonald's and Coca-Cola, which have been paying consistent dividends for decades. Those who bought shares of these companies years ago and held on to them are receiving growing dividends today without having to worry about short-term variations. By reinvesting, you are buying more shares, which in turn pay more dividends, creating a cycle of continuous growth. Imagine you invest in a company like 3M, which not only pays dividends regularly, but also increases them year after year. Instead of spending these dividends immediately, you reinvest them, increasing the number of shares you own, which in the long run can result in much greater wealth. This long-term approach requires discipline and patience, but the rewards are undeniable. While many investors get distracted by market movements or seek quick returns, those who commit to thinking about the future reap the benefits later on. And this brings us to another important question. What are the best stocks for this? That's exactly what we will see next. Blue-chip dividend stocks. The so-called blue-chip dividend stocks are the backbone of a good portfolio, especially for those seeking stability and a continuous income flow. These are large companies with established reputations and a consistent history of paying dividends. Investing in blue-chip stocks is like assembling a machine that generates income automatically and accurately. You know that once activated, it will continue to operate without interruptions, even when the external environment is turbulent. These dividends are the fuel that keeps the machine running, delivering consistent results regardless of market fluctuations. And the most interesting part is that these companies not only pay dividends, but often increase them, which means your passive income will also grow over time. Imagine that you bought shares of Coca-Cola 20 years ago. Today, the dividends paid by those shares are much higher than when you acquired them. Another point that makes these stocks a good choice is their resilience in times of crisis. During the 2008 crisis, for example, many companies suffered, but companies like Microsoft and ExxonMobil maintained their dividends or quickly recovered, continuing to deliver results. This is especially important for those building a portfolio for retirement, where the predictability of income makes all the difference in keeping financial planning in order. Therefore, blue-chip stocks should be considered the foundation of any long-term portfolio. They provide both stability and growth and, when combined with other strategies, can accelerate your path toward financial freedom. But if you are looking not only for stability, but also for continuous growth in dividends and are willing to take on more risks, it might be time to look at another type of stock. Dividend growth stocks. Dividend growth stocks are a true treasure for the long-term investor. Unlike stocks that simply pay dividends, these companies are committed to increasing the dividends paid to shareholders over time. This means that in addition to receiving consistent passive income, this income grows each year. The power of these stocks lies in their ability to compound gains over time. Think of them as a faucet that, in addition to already being open, gradually increases the water flow. The longer you keep it open, the more abundant the flow becomes. Companies like Texas Instruments or Visa, which have historically increased their dividends annually, exemplify this strategy well. This ability to regularly increase dividends helps the investor protect their purchasing power against inflation while simultaneously increasing the value of their portfolio. A crucial point in choosing good dividend growth stocks is to observe not only past growth, but also the sustainability of that growth. Companies that manage to increase their dividends over long periods generally have robust business models and good cash management. Johnson & Johnson, for example, has increased its dividends for over 50 consecutive years, which is a sign of consistency and financial health. This type of commitment to growth greatly benefits the investor who is aiming for the long term. Therefore, investing in dividend growth stocks is a great strategy for those who want to see their income grow over time. They offer both stability and growth potential. And if you want to maximize this income even further, next I will show you a concept that can help in this mission. Covered call ETFs. Covered call ETFs are an interesting strategy for those who already own dividend-paying stocks and seek to further maximize their passive income. This approach involves selling call options on the stocks you already own. In return, you receive a premium for selling these options, which acts as a bonus on top of the dividends you already receive. It's like renting out your shares temporarily in exchange for extra income without giving up ownership of them. ETFs such as the Global X Nasdaq 100 Covered Call (QYLD) or the JP Morgan Equity Premium Income (JEPI) are popular examples of this strategy. However, it is important to understand that this strategy has its limitations. By selling a call, you limit the potential appreciation of the stock. If the price rises significantly, you might be forced to sell your shares at the predetermined price set by the option. Therefore, covered call ETFs are an excellent choice for those seeking a higher income flow but are not necessarily interested in seeing substantial growth in the stock's value in a short period. This balance between income and growth can be exactly what some investors seek at certain stages of life. This type of ETF can be especially useful for those nearing retirement and wanting to maximize their monthly passive income. Instead of relying solely on dividends, this strategy adds an extra layer of financial protection. Imagine you own shares of companies like Apple or Microsoft and decide to use covered calls to generate additional income. You continue to receive dividends and also earn extra income from the options sold. This can provide a significant increase in your total passive income. Let's look at a practical example. If you own $50,000 in stocks and sell calls with a premium of 1% per month, you can generate an extra income of $500 monthly in addition to the dividends. Although this strategy may limit capital gains, it offers a real opportunity for those who desire higher income from their investments. For many, it is a natural step after building a foundation of dividend-paying stocks. To achieve $4,400 in monthly dividends, you can combine several strategies that reduce the necessary capital. By investing in stocks that increase their dividends annually, along with covered call ETFs that generate extra income through option sales, the total yield can rise considerably. With a dividend yield of 4%, combined with an average annual stock appreciation of 8% and option premiums, it is possible to achieve an effective yield of about 9%. In this scenario, to reach $4,400 monthly, you would need to invest approximately $587,000. This demonstrates that with a well-planned strategy, the required capital can be significantly reduced, accelerating your journey to financial freedom. Now that you have discovered Warren Buffett's secrets for living off dividends, the big question is, will you continue to just watch the opportunity pass, or will you take control of your life? The path to earning up to $4,400 per month with dividends is no longer a mystery. You already have the tools in your hands. Think about it, wizards. In a year, you could look back and see that you took the first steps toward your financial independence. Or you could be exactly where you are today, still thinking about what you could have done. The choice is yours. If you want different results, you need to act differently. And that action starts now. Subscribe to the channel, activate notifications, and dive headfirst into this universe of knowledge that will change your relationship with money. Your dream retirement could start sooner than you think, but only if you take the first step today.